Dear viewers, welcome to this episode of Your Life, Your Money. This episode is all about solving the dilemma between should I try to aim more returns or should I try to save on the taxes? What is the trade-off between the two? Which one can you control, which one you cannot control, and how you have to approach this particular problem? In this episode, you are going to find answers for this dilemma. Stay till the end of the video. I will give you 10 different ideas by which you can save taxes and increase your returns. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
When you invest your money, you should always focus on things that you can control. I am a great proponent of things what you can control should be controlled and exercise that particular option. In your investment, what is it you can control? Can you control the return? The answer is no. Can you control the taxes by proper choices? You can do that. So always when you decide where you invest, how do you invest, which asset class you pick up, which instruments you pick up, you also check the taxes that come along with that. If you find a product and you know what is the likely return you are going to get, the next question to ask is how much taxes I have to pay when the maturity comes in. What is the percentage of the tax? Do I have to pay tax every year? Do I have to pay tax at the maturity? What is the rate of taxation? Ask all these questions. The best way to increase your return is to save on the taxes. You get a certain rate of return and you have to shell down a higher taxes in product 1 and a lower taxes in product 2. Then you should be choosing the product 2 which gives you lower tax incidence. So the best way to compare is post-tax return. Which one is more efficient? You choose that particular instrument. Having said that, now I'll discuss 10 different possibilities that you can exercise, be it the type of taxation, be it the type of products that which gives you offer. I will discuss this in this part of the video and you decide what suits you the most. Tax saving idea number 1, income tax versus capital gains tax. There are instruments which will come under income tax, which means the income generated from that, you have to compute the income on a yearly basis and you have to pay tax then and there itself that year and finish it off. There is another way which is called the capital gains tax. Of course, it's a subset of income tax, but you pay the taxes at a different point of time, and when you sell it, you don't pay it on a yearly basis. That's a capital gains tax. So income tax follows a particular slab rate. You may be in a nil tax, 10%, 20%, 30%, then the cess will increase. It goes all the way up to 39%. Whereas in case of capital gains tax, it could be coming within the slab rate or it could have a different rate. See, for example, the long-term rate in case of mutual funds is just about 10%. So if you choose an instrument which comes under the capital gains tax, the chances are that you save quite a bit of taxes using that method. So ask when I have to pay taxes. Idea number 2 to save the tax. Accrual tax versus deferred tax. It is more or less similar to the previous idea what I said, but I will just explain to you for ease of understanding what is accrual tax versus deferred taxation. For example, now you maintain a bank fixed deposit and you book this FD for 10 long years. You get your money at the end of 10 years. But when you're filing the tax return, how do you file the tax return? You take a certificate from the bank. What is the interest that is accrued for this year? You compute that in your income tax and pay taxes. This is called accrual tax, which means to say whether you have drawn that money out or not, but it has accrued in your account and that is treated as your income of the year and you have to pay taxes. Let's compare a deferred tax. Now let's say instead of putting the money in a bank fixed deposit, you have put it in a debt fund. What happens? Now in case of debt funds, you do not compute how much of money you have got that year by way of rise in NAV. You pay taxes on deferred funds only when you sell it. Now again, let's do a comparison. Now you put the money in a debt mutual fund, which is similar to bank fixed deposit, and you hold it for 10 years and after 10 years you sell, similar to bank FD. You pay all your applicable taxes at the end of 10 years. In case of bank fixed deposit, you pay every year for the accruals you made. In case of a debt fund, you pay all the taxes that you have to pay at the end of exit point, which is 10 years or whenever it happens, could be more than 10 years, could be less than 10 years. What is the advantage for you? Instead of paying the taxes today, you pay taxes at a future point of time. From now till the future, the money which will not go out will have a compounding effect effect. So your post-tax returns would improve because of accrual tax versus deferred tax. If you have to choose an instrument which will give you deferred tax incidence. Tax saving idea number 3. If you're an NRI, you have an option to do fixed deposit using your NRI account or through your NRO account. Now, if you do your NRI FD, the interest that you get from that is tax-free in India. I stress the word, it is tax-free in India. However, if you are living in some countries, could be UK, could be Ireland, could be Canada, could be USA, it could be getting taxed as your income in that country. Your CPA is the best person to tell how the tax treatment happens over there. So this is possible to save the taxes if you make NRI FDs. Many people are not aware about this. Instead of that, they send money into their NRO account. They have just not opened NRI account, or they are not aware that they are not required to pay taxes in NRI FD. They start a NRO FD. And NRO FD and the resident FD for tax treatment, it is one and the same. Plus, the NRIs have to shell down a hefty TDS when you do an NRO FD. So by just choosing NRI FD or NRO FD, you stand to save a lot of taxes. Many people are of the opinion that the money which is there in your NRO account cannot be converted into NRI. No. This can be converted into NRI account. There is a process to follow here. We have a very popular video on our channel, how to convert your NRO funds into NRE funds. Please watch that channel where we have given the detailed instruction how you can do it. Take that one step today and save the taxes for future. A lot of NRIs are there in the Middle East and a lot of other countries where they are not required to pay taxes in their country where they are working with. So they can make best use of this to save on the taxes. Dear viewers, by the way, we help people to save on the taxes. We understand how to save taxes, what instruments will save you taxes, how we can design things for you. If you have an intention to invest in a tax efficient way, you can make best use of services provided by NRI Money Clinic. We have team of experts to help you and they are ever ready to help you. How you can reach out to us? Very simple. Our numbers are given in the description box below, as well as we have given a link over there. Reach to us through a WhatsApp message. Just click on the link, it takes you to the WhatsApp message, send us an exploratory message, and our team of experts are always ready to help you to save on the taxes. Make best use of this. Send that message today itself. Tax saving idea number 4, FCNR deposit for returning NRI. FCNR deposits are nothing but the NRI FDs in foreign currency. If you are an NRI, you can continue to hold it. But if you are a returning NRI, as soon as you come back to India, your NRI FDs have to be converted into resident FDs and the interest that will be taxed beyond that point as an accrual tax. One of the best ways to save on the taxes, if your focus is to save on the taxes, is to convert your NRI FDs or NRI funds into FCNR deposit. If you convert this into FCNR, if you have provision under RNOR, resident not ordinary resident, for the period of RNOR status for which you are eligible, you are not required to pay any taxes on the interest or the capital gains that you get on the currency appreciation during your RNOR phase. What is RNOR phase? If you are a person who is not familiar with this terminology, just go and search on our channel the videos on RNOR phase, and we have done many videos to explain to you how you can make best use of RNOR phase for the returning NRI. So this is one another instrument which can save you a lot of taxes. Idea number 5, tax-free offshore investment, dollar investment, which are coming from many of the tax-free areas. You have Cayman Islands, you have Isle of Man, you have Singapore, and various territories which give you a tax-free income or tax-free investment opportunities. If you're an NRI, you can make best use of these locations to save on the taxes and gain. One of the very interesting thing which is happening right now is the FD rate on Indian rupee account versus FD rate on the dollar account is almost similar. Not a great deal of difference is existing between these two. Very soon, NRI Money Clinic will roll out opportunities to invest in dollars via offshore accounts. If you're a person who is looking out to invest via dollar forms in a tax efficient way, tax free way, be it the fixed income, be it the equity side, we can help you on on that. If you have an intention to invest via dollar route, just let us know your interest through the WhatsApp message. We have given our link over there in the description box. Send your message and our team of experts who is looking after this will reach out to you and help you on that. The offshore accounts, what it means is these are in the tax-free locations. You are not required to pay any taxes on that. This can also be utilized by the returning NRIs because during your RNOR phase, your investments held outside of India will be tax-free during RNOR phase. However, once you complete your RNOR phase, then it will be treated as overseas income of a resident Indian. Till such time, at least for 2 years, you can save on the taxes. Tax saving idea number 6, the very popular, the mutual funds. The mutual funds are one of the finest ways to increase your returns or reduce on the taxes. The potential returns you get from the mutual funds is far higher than any fixed income instrument. I will not guess how much returns you are going to get. Historically, it could have given 12, 13, 14, depending on what stage of the market currently we are passing through or when did you start investing. But you can't say that all the time it will give you the same return. It's very safe to say that they will give you much higher return than the bank fixed deposit. The interesting part is the returns you get from that is coming under the capital gains tax. If it is a long-term capital gains tax on the equity segment, it's just about 10%. Plus, it's a deferred taxation. It's not an accrual taxation. So you get a higher return, taxes are deferred, and the tax slabs are lower. Whether it is an equity fund or whether it's a debt fund, both the cases will come under deferred taxation. They come under the capital gains tax. So it saves you a great deal of tax. Make most of it by investing wisely in the mutual fund. Again, we do have service for people who want to start investing in the mutual fund. You can make best use of our services as well. Tax saving idea number 7, unit linked insurance plan. Unit linked insurance plans are similar to mutual fund, but they'll come under the insurance segment. Government has given you an exemption on taxation if you invest up to 2.5 lakh per person per year in the unit linked insurance plan. I have done detailed videos on ULIP plans on this channel. You can search on our channel, just type ULIPs and these videos will get highlighted. To know more about these ULIP plans, you can search for these detailed videos. They will also save you a lot of taxes. 0% tax if you are investing only up to 2.5 lakh per year per person. If it's a husband and wife, you can put up to 5 lakhs because 2.5 lakh for husband, 2.5 lakh for wife. Even if you cross this 2.5 lakh, the unit linked insurance plans have a great deal of tax arbitrage. For example, now if you are rebalancing your portfolio and let's say that you are holding it in the mutual fund, then at the time of rebalancing, applicable taxes have to be paid, and as a consequence of it, the amount available for rebalancing comes down because of the taxation. However, when you do it through the unit linked insurance plans, this tax will not suffer and you are required to pay tax only at the maturity, that too if your contributions are more than 2.5 lakh. ULIPs have gone through a tremendous transformation. They have become attractive plans. The regulators, the insurance companies have changed these plans to a great extent. You don't have to be hesitating. The only word of caution I would say is there are several caveats I have given who can invest and who should not invest. In my video, 11 things you must know about the ULIP plans. Watch that video, find out what are the things that I have said there. If you fit into this, you can openly invest in those plans. Tax saving idea number 8, guaranteed return insurance plans. These are something which can substitute for fixed income like bank fixed deposit or some of the debt funds which are there in the mutual fund. Of course, you have a limitation. Government has given a limitation to say you can invest up to 5 lakh rupees on this plan per year, and the output, the maturity or the regular stream of income that you get is 100% tax free. If you are a person who is maintaining a lot of fixed deposits in the bank, or if you are a fan of fixed income, you should consider investing in these particular plans which give you 100% tax-free benefit. There is one another great advantage with this guaranteed return insurance plans. These plans run for longer periods of time. You pay for 10 years, 12 years, 15 years, depending on which plan, how do you intend to pay for it. But the rate of return you get on this plan get fixed today itself for the entire length of the plan. If you have maintained the money in a bank fixed deposit, number one, it comes under income tax, it comes under the accrual tax, and you have a reinvestment risk. When your FDs mature, you have to renew the FD at the prevailing interest rate. Obviously, the future interest rate is lesser than today's. But in case of GRIP plans, you start the plan today, you lock into the current interest rate, and whenever the interest rates fall, you will not get affected accepted, and that's a great advantage for the retiring people. That's a great advantage for people who are looking to create a second income. That's a great advantage for people who are in the working age group and who are suffering from this 30% tax bracket. There is enormous amount of taxes you can save on this. Don't listen to people who only talk about you shouldn't be investing in insurance segment. They are as good as any other instrument. You just have to fit whether it meets your requirement or not. If it meets your requirement, you can boldly invest in these plans. In fact, in the last 2 to 3 years, these plans have become so popular, the insurance companies are raking up a huge amount of business from these guaranteed return insurance plans. Idea number 9, investments in National Pension Scheme. NPS at the time of entry will give you some tax break. I think it's 50,000 rupees. But the best part of NPS scheme is it is illiquid. For those of you who are very trigger happy to take out the money after your investment, NPS is one of the finest thing where you can put your money into it, lock it up to 60 years of age. Nobody can touch that money after that. At the end of maturity, 60% of the proceeds that you get from that can be withdrawn, and it is 100% tax free. 100% tax free for 60% of the money. The remaining 40% has to be converted into an annuity. So you can make best use of NPS, but be cautious that the monies that you put on the NPS will become illiquid. You have to do your calculations right. If you are a person who needs money somewhere in the interim, NPS will not serve your purpose. But for everyone there is a retirement, you can make best use of NPS to the extent possible and save on the taxes there. Idea number 10. Government schemes like PPF, EPF. The money that you put on that is 100% tax free. Plus it has a differential interest rate. Now the PPF gives you a rate slightly higher than the bank FD. Likewise the EPF. The maturity proceeds are 100% tax free. Make best use of these schemes. Very secure. You will get a differential interest rate. You have to pay zero taxes. Whatever you are eligible for, make best use of this to save on the taxes. I have given you the 10 points till now. I'll give you one bonus point extra for the NRIs. The bonus point is the double tax avoidance agreement. The double tax avoidance agreement changes from country to country. I will not take any specific country here. If you're an NRI living in any specific country across globe, you should look out or take the assistance of your chartered accountant to dig into double tax avoidance agreement. And each DTAA has provided tax relief for people who are living outside. Find out what relief you have under double tax avoidance agreement. Make best use of it to save on the taxes on the instruments where you have invested in. Dear viewers, hope the video that I have done today gave you enough ideas to save on the taxes. You make most of the services we provide and save on the taxes. The taxes that you saved, needless to say, is the additional returns you have made on your investment. If you like this video, please do not forget to give me a thumbs up on the video. If you are a person who is watching this channel for the first time, or if you are yet to subscribe for this channel, please hit the subscribe button and press the bell icon. Do not forget to share these videos with your near and dear ones, friends and relatives, and on all the WhatsApp groups on which you are connected with. Thank you very much for watching this episode. On NRI Money Clinic, I shall come back with you with yet another idea on your life, your money next Friday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.